Hi, this is ProACT Sam with this episode of the Live and Work Abroad show at the start of the new year. It's also the spring budget, so it's not a coincidence that the uh, UK budget is traditionally at the end of March, springtime. So start traditionally also the historic start of the new year in the UK. But what we're braced for, although they're not calling it a budget, the PR playbook says that it is a spring statement. It's a budget. It's always been a budget, and it'll be a budget this time. And it's about spending cuts because they've already introduced £36 billion of tax spending budgets that are going out to people as a taxpayer in the UK in the year ahead. That's increases in national insurance from employers. Anybody who's earning over £100 a week now in the UK is going to be paying some sort of taxes on national insurance or income taxes. The freezing of the thresholds is adding more and more people into tax as the years go by. But what economists know is that for a growth economy, you need low taxes to encourage investment and innovation to build up a business. And without that, you just get stagnation. What we've seen is that £36 billion of taxes announced for the government to then announce two big spending projects, one in West London to build a third runway at Heathrow Airport, and there's one in East London to build a tunnel under the Thames, another tunnel under the Thames. More state spending for the metropolitan elite in the London conurbation. It doesn't benefit the whole of Great Britain. It doesn't bridge the divide and help the north or the regions. You've got the biggest spending tax increase in the budget ever, and it's only going to lead to more uncertainty going forward. But let's have a look at the history of the British budget. And what I want to say to you, because I'm a bit old-fashioned, is Happy New Year. 25th of March, the equinox, was traditionally the British New Year through to 1752. And that's the way it's been for all these many years. The Romans set it up this way. March was the first month of the year. The time you start planting and growing your seeds, and even we had the months named after the Roman numerals. So September, October, November, and December, 7, 8, 9, 10, with the 7th, 8th, 9th, 10th month of the Roman year. Rome had calendar had 10 months. July and August were named after Julius Caesar and his son, and that was the 10 months of the calendar year. But it was inaccurate, and it allowed for adjustments that needed to be made every year. And in the 1580s, the Catholic Pope in Rome decided to change and adopt a new calendar in order this to be adopted throughout Europe. Brexit Britain, even at that time, still didn't join in with Europe. And although Europe had changed to a January the 1st calendar year from the 1580s, with a new month, February, with only 28 days and the leap year introduced to make the adjustments automatically, so that the calendar, the annual calendar, would stay in sync with the solar system and the equinoxes and the seasons. And it wasn't until 1752 that the UK then finally changed and reverted to fall in line with Europe, but with an unintended consequence. And it was almost like in 1752 the politicians didn't know what they were doing, and they were taking the masses, the population, of a liberty, trying to tax them more, even back then. What it meant in 1752, switching to the new Gregorian Roman calendar, it meant that there was an extra 11 days to be included in the first tax year. So the first tax year in the UK, would it, the people would have lost 11 days, and there's rioting for that. And as a consequence, in the short-term fix, the government decided to appease the masses by moving the tax year for 1752 to 1753 to the 5th of April, 11 days later. So the people didn't lose that 11 days, didn't get 11 days extra tax for that 1 year. It's a temporary measure until they can work something out about changing the tax year from the 25th of March to the new, in line with the new calendar year. And it never happened. So still today, in 2025, we've got the 5th of April is the British start of the tax year, and something for us to look forward to. So what have we got to look forward to this year in the spring budget? Spending cuts, because they've already introduced a whole range, an additional £36 billion of taxes in frozen thresholds for income and capital savings taxes. Dividends and savings taxes are actually going down, so everybody's going to be paying that bit more. There's 1 million 45% taxpayers now, and 3 million more basic rate taxpayers than in 1990. So in 1990, the 3 million people that were paying no tax because they were below the personal tax threshold are now paying the basic rate income tax. Another 3 million that were only paying basic rate in 1990 are now paying the 40% tax. So taxes are going up because the thresholds are being frozen. And even so, if that wasn't enough, capital gains tax in the UK is going up by 80% from this year. So it's gone from 10% to 18% for your investments, your crypto, and your property sales in the UK. Inheritance tax thresholds are also frozen, but in addition, pensions are added into the inheritance tax calculation, increasing the amount of your capital and your wealth that's going to be taxed at 40% when you die. And if you're making investments in property meanwhile, your relief on stamp duty is going to be reduced by £125,000 of extra capital that's going to be paying that tax. The allowances for dividends, the allowance for interest is reduced, and somebody on over 50,000 a year income is now getting less than 500 a year allowance to receive interest before they pay tax. In 1990, there were 1.7 million people paying 40% tax. In 2025, there's going to be 10 million people paying high rate tax. And that's not necessarily because their income is that much better. It's because the thresholds have been frozen persistently over the years. But the government borrowing is designed to get a grip on that. So cut the spending, cut the borrowing, and then growth can come from that. Except that the week after the spring budget, we're going to have Liberation Day in America. 2nd of April, it's a big day. Donald Trump has deliberately moved it from the 1st of April because he didn't want it to be All Fool's Day. He wanted it to be a serious political statement that Liberation Day for America's economy is when people that the Trump administration feel that are trading unfairly with America in Europe, in Asia, in China, in Central America, in Mexico, in Canada, any countries where he deems the trade to be unfair, he wants that to be balanced by applying a tariff. These are highly likely to create uncertainty and instability in the markets going ahead. So we wait to see what's going to happen on Liberation Day. We know that in the last government, where the Tories were trying to reset and introduce a low tax, low growth economy, that destabilized the world's economy, allegedly, and British gilt prices crashed. And that was deemed enough to turf her and Liz Truss and the policy out of office and bring back a high tax, high spend government under Rishi Sunak and Jeremy Hunt. So will that happen again? Will this happen now, where we've got a high tax, high spend government in place? Will we get instability anyway from the Trump's attempt to reduce the tariffs and bring investment back into America? It's already working where you've got companies like Hyundai have announced massive investment in American factories to build their cars in America, so to avoid an import tariff from Korea into America. The converse situation, the bizarre one, is that Tesla, led by Elon Musk, one of Trump's key allies, build a lot of cars in China and import those into America with tariffs. So how's that going to work for them? So we could get another financial meltdown, but not from trying to reduce taxes and deregulate. In a high tax, highly regulated state spending UK, the financial meltdown could force up the cost of gilts and the price of funding that high debt that the UK government have got. So Liberation Day on the 2nd of April could mean that the budget statement is a bit of a fool's errand and it needs to be rapidly adjusted in the next week. We will see. If you want more help and advice on protecting your assets and investments from inheritance tax, capital gains, and on your overseas property and business, living and working abroad, contact us at ProACTPartnership.com. In the international tax environment, the G20 are pushing hard for wealth taxes. Now, officially, there's not many countries around the world applying health taxes at the moment, but the G20 want to find ways to do it. Spain and Norway among 3 countries in Europe that do apply a wealth tax unsuccessfully. But if you consider Portugal, they have what they call a solidarity tax. So if you've got Portuguese income over 80,000 euros, you're paying 2.5% tax on that income, and that goes up to 5% over £250,000. So a wealth tax can come in by the back door and be a real factor. In some countries, they have a tourist tax, they have health taxes, they have travel taxes for airline seats for people visiting the country. We need to watch for this insidious way that these backdoor taxes, these little extra taxes can be introduced into the economy and further sap capital away from people to invest and grow their family business and property investments. In the UK, council taxes are being singled out as a form of wealth tax, where the more successful you are and the nicer property you've got, the more your council tax goes up to pay those bills. If you want more help and guidance on protecting your income and your capital and your dividends from taxes with your overseas property business and investments, contact us at ProACTPartnership.com. Inheritance tax changes are a real threat to expats living and working abroad now, and it's not going to go away. The changes have been introduced to bring pensions under the scope of inheritance tax. We're only going to increase the tax take from inheritance tax, where the thresholds have been frozen for 10 years now, and they're not going to go up anytime soon. Further evidence of that recently is that many people in the UK invest in a residential property portfolio, and possibly with holiday lets. And there's a court ruling in the last month in the UK where, on appeal, the taxman won its assessment of inheritance tax on an estate from 2017. If you got holiday lets and you try to claim that it's a business, then potentially when that business is sold, selling a business gives you a principal business relief, a tax relief on selling your business against the inheritance tax of between 50 and 100%. What the High Court ruling in March 25 confirms is that if you've got a holiday let, if you've got residential property holiday let business, that is not eligible for business relief against inheritance tax on disposal. So it just comes under the full rate of either capital gains or inheritance tax assessment. So more inheritance tax for the future. And the government are committed in 25-26 to finding ways to make sure that they can protect their claims to inheritance tax on expats living and working abroad. What I want to do now is just address the start of the tax year. So, as we said, the start of the UK tax year is based upon a tradition before 1752, where it was actually New Year's Day in the UK, and the tax year stuck around about then, albeit on adjusted 11 days on the 5th of April. So the new tax year is starting for the UK on the 6th of April 2025. You can't actually submit your first return until the 7th, 6 being a Sunday, and things aren't quite ready. You need to submit a UK tax return if your income is above a certain level. If you're earning higher rates of income, if you requested to do a return in the UK, or if you've got property rental income or a capital gain, then you must complete that UK tax return. It's also, because there's changes to the domicile rules, there's more people going to be brought into the scope of inheritance tax. So after the 6th of April, an expat leaving the UK is still going to be tied in for inheritance tax and capital gains taxes after they've left for a period of time of maybe 10 or 20 years. So even while expats leaving the UK have got certainty that they can shake their UK domicile and the UK tie, it's still something that's going to be stuck with them for many years after they leave the UK. If you're an expat with a tax return requirement in the UK for property rental, investment, business, or payroll issues, you want advice and guidance or reports, ProACT Partnership available to help you. You can contact us at proactpartnership.com. Expats in Cyprus will also notice that the tax year in Cyprus is synced to a degree to the UK. Now, the actual tax year in Cyprus is the calendar year to December, but generally the individual tax returns are due from and by March each year. So an individual's tax return is due from March, but the tax returns for the previous year, they can start submitting from March each year. You can have up to a year to complete those. So between the end of March 25 and the end of March 26, all the tax returns for individuals, property renters, sole traders, companies and individual tax residents of Cyprus need to submit their tax return, and those are available to complete from the start of the new tax year at the end of March 2025. One of the changes that they've announced this year is to reconfirm that if you have income in Cyprus which is below 19,500 euros, you don't need to complete a return. But there's a catch with that, because that's defining income as in earned income. Not all income is earned income. If you've got dividends or interest or property rental income, then there could be other taxes that are charged to that income, and it could actually mean that you've still got a tax liability. Now, it may be that tax could be paid on a self-assessment basis and still not need to do a full return, or it could mean that you do need to do a return at some point in the future. The adjustments being made each year to try and bring the Cypriot system into line will continue as they go digital along with governments around the world. But for this year, If you've got earned income below 90.5, you definitely don't need to do a tax return. But if you're a sole trader, if you've got residential property and you're letting it, you need to do a tax return. If you've got any family trust investment income, then you need to do a tax return. And technically, Cyprus also has a worldwide tax on, they call the health tax, which is chargeable at 2.65% on all your income around the world. No capital gains tax in Cyprus, so no dividend tax if you're registered as an expat. So Cyprus remains very competitive. The main time that you absolutely need to have a tax return is on two occasions. One, when you're dead, and the second, when you sell property. When you sell Cyprus real estate, you need to get tax clearance. When you die, your estate needs to get tax clearance before assets can be transferred to beneficiaries. And that is, you need at least 5 years worth of tax returns. So ProACT advise our tax clients that to do a tax return each year to make sure that if there is a bit of tax you need to pay here or there, all your tax records are up to date, and then if you need to relocate overseas or start renting property, or you've got a business issue, employee issue, inheritance issue, gifting issue, selling property, you're not going to have any complications in historic records that you're going to need to recover. For more information on Cyprus tax registration, returns, or advice, contact us at ProACTPartnership.com. In Cyprus, it's a lovely sunny Mediterranean island, and we suggest that you don't worry about your health, but you could do. So in the UK, anybody who's resident in the UK qualifies for NHS treatment, whether they're taxpayers or not, as long as they're legally resident in the UK. In Cyprus, to qualify for the health service, you either have to be a citizen, a permanent resident, or you need to be working expat and paying social insurance as an employee or as a sole trader, or you could be you could have an exemption because you're getting a state pension from an EU country. So the UK and the EU countries have got a cooperation social insurance agreement, and any EU or UK citizen with the state pension can have their health benefits transferred to another country that they're living as a tax resident in, and that includes Cyprus. So to qualify for Cyprus healthcare is immediately possible, but it's not automatic. So if you're an expat living and working abroad in Cyprus or relocating overseas to Cyprus, contact the ProACT EU office in Cyprus to make sure that we can get you covered with your social insurance and national insurance and healthcare benefits. For more information and guidance, contact us at ProACTPartnership.com. One last thing to leave you with today. If you're UK expat or any type of expat, you might be used to sponging off the BBC. The BBC is traditionally a universally free service in the UK for everybody who pays a TV license. In effect, the TV license is the fee for the BBC, but the UK are too stuck in the mud to introduce it as a subscription fee, like people do for Prime or for Netflix or for Apple TV or any of the other subscriptions. So people are willing to pay a subscription service. It's compulsory in the UK if you're watching TV in the UK. But obviously in the modern world, it becomes more and more unsustainable. And the UK BBC is looking for more ways to generate revenue, and advertising is the way that it's going. And of course that then conflicts with the other public service broadcasters in the UK that rely purely upon advertising, like the ITV network and Channel 4 and Channel 5. They're going to see some of their advertising revenue potentially taken away by competition from the BBC. But that's it. Now, for expats, you need to make changes going ahead. So you're going to lose access to automatically getting the BBC services. You're going to need to connect up on a new website, get more adverts, and more adverts and more adverts to get a limited range of content. So you won't necessarily be able to listen to all your channels all the time. You listen to some of them some of the time. You can get people droning on about news and political issues, but not necessarily listening to a cutting edge music or your favorite production shows like that. Not to say that you can't access things while you're overseas using VPNs, but all this is a big world of change. And obviously what the BBC are also trying to do is sell their own generated content onto the wider platforms like Netflix and Amazon Prime. So it's a big change for expats. So if you do tune into the BBC, look out to make those changes and let us know how you get on with the changes that are coming in from the start of the new tax year and the start of the new year traditionally. So forgive me for living in 1752, but Happy New Year. Have a great year. Your tax returns are due now. For advice and tax registrations and tax returns, contact us at proactpartnership.com. Thanks a lot for listening, and we'll see you again next time.